Another mainstream talking point as well, interest rates are going to go up, so gold and silver have to go down. Well, the 1970s speak entirely against that because interest rates went up for the whole decade, and gold went from $35 to $850, $875, whatever. So that's kind of a misnomer, but understand if interest rates go up, it blows up the debt bubble. You've got to ask yourself, why did I buy gold? Why did I buy silver in the first place? Do you know why you own gold or silver? Do you own gold or silver because it was going up or because you thought it was going to go up? First off, gold and silver don't do anything. They don't go up. They don't go down. They are a piece of metal that we've been fooled into pricing in fiat terms, in dollars, in yen, in euros, what have you. The way it should be, the price should be quoted is right now, the dollar is 1/4,000th of an ounce of gold. 25 years ago, gold was 1/300th. If you look at gold as being priced in dollars, it's not as shocking that the price is going from 300 to 4,000 or 5,600, whatever the high was. But it is more shocking if you're looking at the dollar that's being priced by gold going from 1/300th to 1/4,000th. That's a complete and utter crash of what's the number, 93%, whatever, loss of purchasing power versus real money in 25 years. But yet, that's not the way it's viewed. It's viewed as, oh, gold's going up or silver's going up. And that's not the case. Getting back to the gut check, you need to go back to before the first time you bought an ounce of gold or bought an ounce of silver. Why did you do that? Were you worried about the finances of the U.S. government? Were you worried about the finances of the government, whatever country you live in? Were you worried about fiat melting down? Well, that's what has happened and has been happening for the last 25 years. So we get this pullback. People are pissing in their pants because 6 months ago, we were not even 6 months ago, 4 months ago, 5 months ago, we had much higher pricing or much lower pricing in the current currencies. Gold and silver were due a correction. They were absolutely due a correction. Were they due the correction we've seen? I think it's way overdone, especially in silver. But if you understand why you own the metal and what the purpose of having capital outside of the system, you should be able to relax a little bit. And if you have funds that are still in the banking system or still in the system, now is a perfect opportunity to get those funds out of the system, into metal, into your hands with no counterparty risk and no default risk. And that's the key, no default risk. We live in a world that is basically insolvent. I don't think there's a large central bank anywhere that is healthy. And I can say that because we know the U.S. Treasury / Federal Reserve are not in healthy positions. The Treasury now is paying $1.5 trillion in interest alone. That is the biggest category of spending other than, I think, Medicare. Or I'm sorry, not Medicare, but Social Security. It's bigger than defense. It's bigger than anything else. And it will only grow, especially if interest rates go higher from here. It's going to grow much, much faster. If you look at the Federal Reserve, they have a negative equity position at this point. I looked at it, I think it was 4 years ago, they had $65 billion in equity, and interest rates have gone up since then, and their bond portfolio has cratered. The number is what, $300 billion or whatever. So they've got a negative uh, balance sheet. As far as other nations are concerned, what do they use? What do the other nations' central banks use as their primary reserve? They use dollars that are issued by an insolvent entity. So you're looking at a financial system literally with no foundation at all. And when this is all said and done, people are going to find out that the only monetary foundation you can have is something real. Now, it doesn't have to be gold, doesn't have to be silver. It could be a commodities basket, like the BRICS are proposing. But in that basket, they're proposing that 20 to 40% of that basket be gold, and then of course silver, and they're going to have oil, et cetera, et cetera. But the bottom line is, we've been living in a fantasy world for however long, because the currencies are nothing. The currencies are, they have no backing other than from the issuer, and these issuers are insolvent.
The other thing you mentioned earlier was people asking you, and I get the same question from subscribers, from viewers on an ongoing basis every month. When will the dollar collapse? When will the dollar collapse? When things are happening on a gradual enough basis, people keep looking in the wrong, they're being told to look for the wrong unit of measure, rather than realizing that gold has been, is, and will always be the unit of measure. Any further expounding that you want to do on that?
No, I think that pretty much sums it up right there. I mean, gold is the measuring stick. If you look at the Dow Jones or the S&P 500 in terms of gold, it's not even close to an all-time high.
Yeah, that's the other thing, is that people get told by their mainstream financial advisors and their retail financial planners and all that sort of thing, you always stay with the market because the market always goes up, goes up, goes up. What they're saying is that the dollar is always being destroyed.
Well, it's a slow motion devaluation, if you will. If you look at currencies that have blown up because of hyperinflation, you initially see a stock market that gets hit 30 to 50%, and then all of a sudden it turns and just does nothing but go up. But it goes up slower than the currency goes down. So you've lost and are losing purchasing power, but you're getting more, dollars, yen, euros, pounds, what have you. And I do want to mention the gorilla in the room that nobody's talked about it for, as far as I know. I mean, I've not seen really anybody talk about derivatives. Derivatives are the gorilla in the room. I mean, Warren Buffett calls them weapons of mass financial destruction. Understand that there's 4, 5, 6 times the amount of derivatives outstanding compared to physical assets, financial assets on the planet Earth. I mean, derivatives bet on weather, they bet on water temperature, they bet on whatever type of bet you want to make, you can make it. There will be a counterparty to it. The problem with that is when the music stops, it's all worth nothing. The winner wins but loses because he doesn't get paid. The loser loses because they lost, and if they lost so big and can't make the payment, nobody gets paid. And this feeds back to credit. It feeds back to the fact that the entire system runs on credit. The entire financial system runs on credit, and the entire real economy runs on credit. I used the analogy of a loaf of bread. I've used it 100 times. You cannot get a loaf of bread to the store shelf of your local grocery store without at least a dozen uses of credit, probably much more than that. But if any one of those dozen uses of credit fails, There's no loaf of bread. Uh, of interest is, I understand over the last 24 hours, credit cards have not been working in Japan. Ask yourself, what would your world look like if that went on for 3, 4, 5 days, a week, 2 weeks? If credit cards didn't work, what's the world going to look like? And that's just credit cards. What if bank credit goes away? Another mainstream talking point as well, interest rates are going to go up, so gold and silver have to go down. Well, the 1970s speak entirely against that, because interest rates went up for the whole decade, and gold went from $35 to $850, $875, whatever. So that's kind of a misnomer, but understand, if interest rates go up, it blows up the debt bubble. Think about the U.S. Treasury. I think in the next 12 months, of the 40 trillion or 39 trillion outstanding, I think there's 10 or 11 trillion that has to be refinanced or rolled over. And it rolls over at a higher rate, which means the debt service amount goes up. What happens to and we're starting to see this, what happens to a commercial real estate venture or any corporate venture that have bonds that got to be rolled over? And they were at 3%, and now they're at 6 or 7%. Is that manageable? Will that work? The bottom line is higher rates. We saw Paul Volcker come in 1980 and raise interest rates and continue to raise interest rates, and it worked because it wrung out the speculation, it wrung out the excess. It put the brakes on inflation. But the balance sheets of the world at that time could handle it. The balance sheets of the world today cannot handle higher interest rates. Higher interest rates will blow this debt bubble. And when the debt bubble blows up and credit blows up, trust me, the only assets that you're going to want to own are gold, silver, other commodity companies, and stocks of those companies that you get the certificate for. Because don't forget about the great taking. The plan is to take your assets.